Welcome to Throwback Thursday. Today we're taking a look back at the dot-com bubble of the late 90s when internet companies boomed and then went bust. But what happened? What caused this wild ride and what can we learn from it? The dot-com bubble took off around 1995 to 2000 when investors flocked to internet companies driving their stock prices up. Many of these companies, often called dot-coms, had big ideas but no profits. By 2000, the bubble burst and many of these companies went bankrupt, costing investors billions. Let's dive into why it happened. Several key factors created this bubble. Speculative investing. Investors saw the internet as the future and poured money into tech stocks without much research, assuming every tech company would be a success. Media hype. The media hyped up stories of young tech millionaires, which drove more people to buy stocks based on excitement rather than solid fundamentals. This constant coverage created a feedback loop: more hype, more investment, and even higher stock prices. Venture capital overload. Venture capital was flowing freely, with investors funding any startup with .com in the name. Many companies focused on fast growth over long-term stability, using massive funding to expand without turning a profit. Lack of earnings and business plans. Finally, most of these companies weren't actually profitable. They were valued on potential alone. When reality set in, stock prices crashed. Investors realized that big ideas don't always equal big profits. So what can we learn from the dot-com bubble? Here are a few important lessons. Do your research. A compelling story doesn't make a company a strong investment. Before jumping in, check the company's fundamentals. Does it have a clear plan for growth? Is it generating profit or at least on track to? Research is the key to understanding if a company has true long-term potential. Beware of hype. When everyone's talking about a can't miss investment, it's often worth taking a step back. Investing based on hype alone can be risky, as we saw with the dot-com stocks. Staying level-headed can help you avoid the roller coaster of hype-driven markets. Look for sustainability. Investments should ideally be built on solid foundation. Companies with strong business models and real profits tend to be more resilient. It's one thing to grow fast. It's another to do so sustainably. Look for businesses focused on steady, achievable growth. The dot-com bubble was a wild time, but it shows us the importance of being cautious, doing research, and not letting hype drive our investment decisions. Financial history may not repeat, but it sure does rhyme. If you enjoyed this throwback, hit that like button and subscribe for more. Join me next week as we dive into another moment in financial history. Thanks for watching, and please remember, this is not financial advice. Talk to a financial professional for advice specific to you.